Hello again, everyone, and welcome to the Options Mentor and another week of market insanity going yet higher. Let's take a look at this chart, folks. Higher and higher it goes based on what? Nobody knows. But here we go. All the way up to right around the close, we got the 666, probably appropriate, 6664, and a high yesterday of 66.71. So on it goes based on nothing, but that's all right. We're able to trade it. Been doing well trading it the last couple of weeks, and even with the run up, so things are looking better for tradability, even though you can't make any sense of it. We're only here to try to get a trade that can stay within inside, our graph and the movement. That's what this is all about. We don't have to pick direction. It can go up, it can go down, and we can still make money with this style of trading. And we can see with the SPX going all the way up there, look what else we have. Complete complacency in the market. No worries. VIX just over 15. And because, we got a rate cut, maybe a couple more coming. So the market's very complacent. Now, I'd be remiss if I didn't mention to you to beware in circumstances like this when we're vastly overextended by any parameter and the market is feeling like partying on. That can lead to very sharp downturns. But I've been telling you that a while. Eventually it'll happen, but who knows when? Could be Monday, could be a year from now with this craziness. But anyway, what can we do about it? So let's go back over here to SPX. I had somebody ask me this week about scans in other instruments. I don't use scans because the only instruments I use for my trading are the SPX almost exclusively, but occasionally other S&P products like the ES or the SPY. And the reason I like to do that is it blends things out a little bit. I don't like single stock risk. Excuse me. So that's why I don't use any other instrument. And not only that, with scans, what can happen, and I've seen this happen to folks, you can scan for something that you think's in your volatility range or whatever you're looking for. But once you find that out, let's say it's XYZ stock, you have a lot of work ahead of you. Still, you got to learn about it. You got to figure out if something's coming that could really move it if you want to be non-directional. You don't want to get in something that's about to have a binary explosive movement one way or another. So finding something that meets your technical parameters is just the beginning. That's why I just stick with the SPX. I know it. I'm a student of it, so I don't have to worry about all the other things that you need to be concerned about whenever you put on an option position like we do in an underlying. So I'm going to rinse and repeat, folks, this week. A trade I really like is once again a calendar. The VIX is a little over 15, but we know the market's very complacent. The volatility, yeah, sure, the VIX could go down a little bit more, which wouldn't be great in a long Vega trade like this. But I like the idea of doing this. I like it next week, not this week. By the way, we have a very heavy news week this coming week. Fed speakers all over the place, including Chairman Powell speaking on Tuesday. There's a PMI on Tuesday, an inflation number, the GDP on Thursday, and then Friday, PCE, supposedly the Fed's their favorite inflation number. So we don't want anything to do with this Friday's expiration. If you expect it to decay at all, you'll be waiting till Friday, no doubt about it, because there's news, even big news, Friday morning pre-market with the PCE. So it's better to go out to the following week, and we'll avoid a lot of that noise and still hope to be out of this trade this week. But we won't have to worry that, hey, we got into a situation where this Friday, our option that we want to decay is expiring, but it won't come down because IV's jacked because of all these reports. Pardon me, I got the cough today. I'm going to take a drink of water. Anyway, so we want to avoid this Friday. Let's go out the next Friday. You'll also notice I'm 4 days wide. That gives us faster time decay. If I was only 3 days wide, let's look at the difference. Well, if I was 3 days wide, say I sold the third, bought the sixth, well, it's $3.85 a contract for calls, 32 theta, 32.50, and 53 vega. By going out one more day, it may seem minuscule. I only get a couple more bucks, but you'll find in reality that this really magnifies quite nicely in getting you more time decay as well as a vega increase. Yes, you're going to pay more for it, but I think it's worth it in this environment. Someone also wrote in the comments last week, they wanted me to compare it to the put counter. You can use put counters, go right ahead. The reason you see me use calendars all the time in calls, or most of the time, is because in this run up crazy market where calls are everything, a lot of the particularly younger retail traders who are coming in here, they mainly do options and they're buying call options because, hey, the market's never going down, right? So, anyway, that gives demand for calls. It also gives you more room with the calls. They're more expensive, of course, but you have more room. Look at this one here. Now it's going to cost you more, $7.30, but your range is 67.50 down to 65.90. So that's about 160 points wide. Let's look at it with puts. It's about $1 cheaper, but your range is under 67.50 down to there. So you lost some range. If you want to do puts, you certainly can. Nothing wrong with it at all. The reason that I do calls is you get just a little more room, sometimes even more room than that. That wasn't one of the more profound examples, but I do think it's worth it. It used to be for years. I traded this style since 2005, and you could put on a call counter and a put counter and change one from the other, and you'd see almost no movement in the graph shape or anything, very little movement in price. But over the last couple of years with the run up, it's definitely changed. So you can use either of those, it's fine. I don't think there's an advantage as far as in and of themselves, whether they're calls or puts. Sometimes people think that, you get trapped in a call put thought process. You go, oh, wait a minute, if it's going down, shouldn't we use a put calendar? That doesn't really matter in a calendar. Because if it's a calendar, it's a calendar. You're selling it, you're this expiration, buying one further out. So you don't have any advantage to being as far as, hey, if it went down, I'd rather be in a put calendar or a call calendar. That's not really going to help you much, if at all. So that's why I do it that way. But I think this kind of trade, providing we don't have some crazy dust up here over the weekend, Monday morning, VIX stays down here under 16, maybe sometime Monday, this kind of trade I think would be interesting in SPY, SPX, or whatever. Trade at paper if you've never done it before, of course, because it's very dangerous to trade anything strategy that you haven't done before live. You want to do it paper. I just threw this up here for fun. For those of you, I don't quite have the stomach for it yet. I'd like to, because I'm a perma bear. But for those of you who really do think the end is nigh for this run up, one of the things you can do is a put diagonal. A put diagonal gives you more room. This is why I like this better than, say, selling call verticals, where it's rapidly in your face if it's against you. But you can see here, look at this put diagonal, where I went out actually beyond 2 weeks from this coming Friday to the 10th, making it 3 days wide. That's what I do with diagonals, whether they're single or double. And then I went up above the market here to 6,700, bought a long put and sold the short put a little lower. So it's sort of a vertical in its own way, but it does have that long out there further. So it gives you this bit of a calendar effect with the graph. So if it goes down, we got nothing to worry about, do we? It could go to zero. We're going to make money. And if it goes up, we still have we can get time decay, but there will come a point, probably 67.20 or so, where you'd want to take some kind of action to protect yourself because it can really bleed off up here. But this would be a great trade to have on if we had a good down move, or even if we'd stay the same. The problem is this trade can require some work for you if we keep up with this up move. So just threw it out there, just a little information for you. Remember the very important point here. Make sure your long is deeper into the money than your short. Totally reverse things around if you reversed it. So take a look at this. What if we did this, for instance? If we sold the 6,700 put and bought the 6685, not so pretty for us, is it? That's why we want to do this the other way around if you're playing it for a down move. And you can make this, whatever width that you want it to be. It could be 10 points wide, 15 points wide, whatever it is you want it to be. So that's fine. Let's go out here to 13th. There we go. So anyway, that's what I have for this week. I think the calendar is still a good trade as long as everything stays the way it is here and we get into Monday. As always, hit the like, subscribe, and notify button. Hey, don't forget to check out the links in my description so you can learn how to really manage these trades. On this channel, I'm just giving you the basics. Hey, here's a trade idea, but I'm not showing you how to manage it here. To learn that, come on over, be with me every day over at arimer.com. Links in the description. And I hope to see you over there. And I'll be back here next week with another edition of the Options Mentor. Have a great weekend, and I'll talk with you next week. Bye-bye.